what got a stimulus with the Swadeshi movement, during which period, of course, a large number of Indian banks were set up. What you had was a situation in which Indian business was actually trying to create institutions which would be able to mobilize savings from the Indian people in order to finance projects which were being undertaken by Indian business or Indian capitalists. And they got a lot of support for this from the national movement. So the first battle for control was to try and in some sense release the stranglehold which colonialism had over the modern financial system when it emerged in the 19th century in India and then developed till the Second World War. Now, some of this occurred, but it occurred in a very strange way, because once there was support which was given to Indian businessmen to try and set up banks, we know that there were a large number of small banks which were set up. They mobilized savings from the Indian public. They used these savings, these banks, as is typical of most banks. All of you know, the equity capital in a bank doesn't constitute at all a significant share of its assets. Most of its investments comes on the basis of the deposit base it's able to mobilize, and therefore really it was that you're using other people's money to finance investment. But what you found is these small banks actually financed projects which the promoters of these banks were interested in, so that you had a high degree of mortality of the domestic banks as opposed to the international banks. You had the Imperial Bank of India, which came from the mergers of the four presidency banks. You had the three presidency banks. You had the Reserve Bank of India, which was created in the 1930s, and you had the exchange banks, which were related to colonial trade. But then you had a large number of Indian banks, and mortality in the Indian banking system was high. So even though you really managed to get, to a certain extent, to release the stranglehold and control of British capital and the British administration of the modern financial system, what you began to observe is that two things had happened. One thing which had happened is that the modern parts of the modern financial system outside what was controlled by the British came to be controlled largely by Indian capital. It came to be very fragile and therefore put at risk the savings of the population at large. And therefore, at independence, the real challenge was a second battle for control. Can the state take control of this component? Because obviously, once colonialism went, so did all the vestiges of the colonial financial system, the colonial banking system. The Imperial Bank was nationalized and became the State Bank of India. The other sort of banks, the banks in the princely state, were amalgamated with the State Bank over a period of time. And then, of course, you had all of these private banks, these scheduled commercial banks, once the Imperial Bank was nationalized and the State Bank was created. So the idea was, since they constituted a very significant share of the total banking system, how can the state and the Reserve Bank as an agency of the state try to win the battle for control of the savings of the nation when the banking system was actually in the hands of the private sector? And we had a long history, a history which went from 1947 to 1969, in which, in the first instance, of course, what was done was really an effort to try, through initially voluntary amalgamations and subsequently through forced mergers and amalgamations, to try and shrink the private banking system, because there were too many small banks which were being misused by promoters. So that, if I remember the figure right, I think we had something like 560 or 561 banks, scheduled commercial banks outside the State Bank of India in 1947. By the time you got to the late 1960s, this had been reduced to about 91, if I remember right. So you actually tried to shrink the banking system. And why did you do that? You did that because that was one way of bringing stability into the system. And a second way, of course, was by actually giving some teeth to the Reserve Bank of India as regulator through the Banking Companies Act, which was revised many times over, I think 10 times even by the mid-1960s. It was amended such that you could put some strength into the hands of the regulator so that you could try and control these private banks, the number of which had been shrunk to make them more viable. The second thing, of course, you did was not merely to try and ensure viability of the banking system, but you wanted to ensure that the banking system actually was providing credit which was broad-based. Now, what did this mean? One, of course, it meant that you needed to ensure that agriculture, which of course had something like, the rural areas which had something like 80% of the population, and even by the mid-60s had only about 22% of the bank branches, that there would be a greater reach of banking into the rural areas. There would be a greater degree of provision of credit based on rural deposit mobilization within the rural areas itself. That is, you don't have credit migration. You don't have an average credit deposit ratio which is high, but a very low credit deposit ratio in the rural areas and the backward states, because all the money is actually going to the metropolitan centers and the urban centers, to Bombay, Calcutta, or Madras at that point of time, Ahmedabad, etc. So you needed to have a certain degree of dispersion of banking reach and banking credit. But more importantly, of course, you needed to ensure that there was an adequate flow relative to its share in national income as well as employment of flow of credit to GDP. What do we know today? We know that if we go back and look at the numbers, starting from something like 2% or even a little less in the late 1940s and early 1950s, and with some signs of an increase, by the time we got to the mid-1960s, the share of scheduled commercial bank advances going to the agricultural sector was still 2.2%. That you were not able, despite the use of some degree of central bank intervention, of regulator intervention. In fact, this intervention during the period between 64 and 69 took the form of a social control policy. You had a credit authorization scheme which said that credit above a certain limit, case by case, had to be okayed by the regulator, because you didn't want all large chunks of credit to go only to industry. You had a situation in which you said that you actually introduced the notion of priority sectors and said that there must be a certain flow of credit to the priority sector. And of course, you had put earlier conditions, first on the Imperial Bank and subsequently on the other private banks, some degree of pressure to move into the rural areas in terms of branching in the provision of credit. This wasn't being realized. The only agency which was actually delivering on its promises, I think in between 1951 or between 55 and 60, the State Bank was asked to do, I think, 500 banks in the rural areas, and it achieved its target. So at that point itself, one thing seemed to be emerging. And what seemed to be emerging was that if you wanted democratic banking, then possibly you have to look to the fact of ownership. Because what you were finding is that most banks, there are examples, the United Commercial Bank, Punjab National Bank was part of the Sahu Jain group. I think the Oriental Bank of Commerce was part of the Tapars. Big business groups controlled most of the biggest banks. And if you looked, the Dutt committee looked at what was happening to credit, and they found that these banks, these top 20 banks accounted for, which belonged to the business groups, accounted for something like 70% of deposits, about 60% of advances, and 10% of that large chunk of advances coming out of the savings went to firms in which the directors in the boards of these banks also had interests in the companies to which the credit was going. So you were basically you had these banks into which you had put very little of your own money. You're mobilizing the public savings and you're putting it into projects of yours, like you did in the period prior to independence, but now you were large. Now you got the benefit of the Reserve Bank being a lender of last resort. From 1961, you had the benefit of credit insurance. So you basically had a situation where the benefits of all that intervention was going to a few big capital business groups. So therefore, even by that time, it became clear that really, if you needed to move in the direction of democratic banking, which achieves all these targets, then it is necessary to look to ownership. Possibly public ownership would be crucial from the point of view of realizing this objective, because if you had public ownership, firstly, you can get, as you did in the case of the State Bank of India, the banks to implement the kind of policies to be broad-based and inclusive that you wanted to achieve. You could ensure stability, because there was a greater possibility of obtaining information when the state owned the banks, as opposed to when the private sector owned the banks. And therefore, there was, of course, right from the time of the pre-independence times, when there were Congress resolutions which pointed to the need to have a public banking system. And finally, it became clear that if you wanted to win the battle for control, if you wanted to win the battle for control and achieve these objectives of democratic banking, then it would be necessary for the state to take over the principal banks. Therefore, nationalization seemed inevitable, and I think one of the most remarkable features of economic policy making in post-independence India was the decision in 1969, influenced partly by the politics of the Congress, but the decision in 1969, driven by the evidence which was coming out, driven by the need to restore some degree of support among the populace. India decided initially to nationalize 14 major banks and then more. And we know what happened. I don't have to tell you. If you take the period from 1969 to 1990, every objective, you look at what has happened in terms of the population per bank branch. You look at what has happened in terms of the percentages of branch in rural areas and semi-urban areas. You look at the evidence and what is the share of rural credit. It went up to 18% for agriculture alone, 40% for the priority sector. All these targets were achieved. And of course, you look at credit deposit ratios at a district level, and you'll find that there are many districts, including districts in backward states, where you had a 60% credit to deposit ratio, which was the target which the government had set. So that process of nationalization is really a process which I think the evidence suggests was moving India, or had moved India hugely in the direction of achieving the objectives of democratic banking. Unfortunately for us, even though that was the evidence, even though the objectives of nationalization as it was declared when nationalization were undertaken have been achieved in large measure with great aplomb, we find that in the early 1990s, a whole process of criticism of the public banking system began. Criticism which was essentially concerned with stating that these banks are inefficient, these banks don't provide good customer service. Some of it may have been right, but you could correct that directly. But that criticism was essentially used to begin to undermine the sort of the control which the state had managed to achieve. So now we've been seeing for the last 2 decades or more, a new battle for control, an attempt of the private sector to restore in one way or another its control over the financial savings of the nation. I just want to point to 2 or 3 things and conclude here, that if you look at it, there have been tremendous changes which have occurred in the nature of Indian banking. But some of these changes are in fact quite pathetic. One, of course, is the fact that you're beginning to see the replication of the kind of democracy which you saw, 5 minutes? You see the replication of the kind of democracy that you saw during the housing credit boom in the United States. If we go to the early 1980s, I'm not saying that was a good thing, but you look at the share of retail advances to people to buy houses, advances to people to buy automobiles or two-wheelers, advances to people to buy consumer durables, advances in the form of credit card receivables. If you look at the share of retail advances to total advances by the scheduled commercial banks in the early 1980s, it must have been in the range of about 3.5–4%. By the time you got to the end of the 1980s, this had gone up to about 11%. And by the time of the 2008 crisis, this was it was about 24% or close to a quarter. Now, on the one hand, you can say that this is democratic banking, because it is reaching credit to the middle classes, because obviously not too many of the poor would be able to borrow at these terms, but it's reaching credit to the middle classes. But what we do know is that this has resulted in a situation where there is a certain degree of fragility, that if you don't back this up with a situation where those who are taking the credit, to whom you are pushing the credit because you have securitization as a backup, are not in a position to meet the interest and amortization payments commitments, then obviously you're increasing the fragility of the banking system. So we had Mr. Tarapur, who is, was by no means a radical banker. He headed the committees which recommended shifting to full convertibility of the rupee. He said in 2000, I think 2009, he said, why is everybody talking about the subprime crisis in the United States? We are sitting on our own subprime crisis, subprime crisis time bomb because of the fact that there's been this huge expansion in retail credit. The second thing which has happened is, while this was happening, we have seen a process in which there's been a massive increase in credit provision within the system. This ratio of scheduled commercial bank advances to GDP, which used to average about 20 to 22% between, let's say, 1990 and 2000, and less before 1990, between 2000 and 2012 has gone up from 20 to 20, and between 20 and 22% to 56%. This is almost like a 2.5 times increase of the credit to GDP ratio. Remember that during this period, there was a substantial increase in GDP because there were many years when GDP was going at 8 to 9% per annum. So if in a period when GDP growth was at its highest, you have this huge rise in the credit to GDP ratio, the denominator is rising, which means the numerator must be just exploding, you're obviously saying there's been a huge increase in credit which has been delivered to the system. Part of this credit, as I said, went in terms of enhanced credit in the form of retail advances. Some of it very positive, like educational loans, but we know now that the defaults on educational loans are rising because people are finding it difficult to repay. They don't get jobs. So the other is, obviously this much of credit could not have gone only to the education sector, and we find that industry, which used to get about close to 50%, about 48% of credit around 1998, by the time we got to the around 2011, 2012, it was still getting about 40%. So there was a 10 percentage point decline, but 10 percentage point decline when the credit GDP ratio has gone up so hugely meant that a huge amount of credit was going to industry. So was this banking democratic, at least in the sense that it was providing credit for growth? Well, when we begin to look at this lending to industry, as many of you all would have known, we find that if you take the share of infrastructure in total lending to industry, the share of infrastructure in lending to industry was 3% in 1998. In 2011-12, the share of infrastructure in lending to industry was 31 or 32%. So what you're basically having is the government now, earlier they used to mess around with the banking system with loan melas. And those loan melas used to be, to poorer farmers, etc. It was a bad thing because, you can't provide a subsidy which is off your balance sheet and put it on the balance sheet of the banks. But on the other hand, at least the money went to some people who are at the lower end of the income and asset hierarchy spectrum. Now what we are finding is that to promote its whole policy of public-private partnerships in infrastructure, the state is forcing the banking system to lend hugely to infrastructural projects in power generation, in power distribution, in ports, in roads, in civil aviation, in the hotel infrastructure. Leela Palace Ventures, is going in restructuring loans, hasn't paid its interest for the last 3 quarters. It's taken huge loans. Why? Because infrastructure. You build these 6-star or 7-star hotels and call them tourism infrastructure, get credit from the banking system. Similarly, we know what happened to Kingfisher Airlines. Civil aviation, you get a huge amount of money. We know what happened to Lanco. These are all private institutions which have got huge amounts of credit as part of this credit splurge. Who gave them this credit? Not the private banks, excepting perhaps a little bit from ICICI. The foreign banks haven't given any credit virtually to infrastructure. The credit has gone from the public banking system. So what you're actually doing is you're undermining the public banking system, and now you're beginning to say they have a capital adequacy problem, so they should actually put out their equity. They should put out their equity to be sold in the market in order to mobilize, equity funds, which of course constitutes tier 1 capital, and restore their capital adequacy because the state cannot keep capitalizing the banks, and because of the fact that their NPAs are increasing, the restructured share of restructured, of course, those are called standard advances and total advances are increasing. So you're basically undermining the public banking system and pushing it towards privatization, which means that in another way, you're allowing now the battle for control to be won by the private sector. And the final nail on the coffin, of course, is the decision, which unfortunately couldn't